Good. Right. So what I'd like to do, is there anybody that's in their first group therapy? Anybody here for the first time? Okay, so we got some people here for the first time. Okay, so what I would like to do is just explain what this is. So the group therapy, it's really an open session. So it's really supposed to be a two-way session. And what we do, we start off with kind of the topic du jour, or just me starting a topic really just to start the conversation. And then we'll open up. Now, there's a couple of things I would like to talk about today. One is, do we have any people new to the tools in the room? Just let me know if you're new. If there's no people new to the tools, then there's a bit we can skip. Okay, we got some new people. Right. So for the new people, what we're going to do is we're just going to go over the drills that we recommend you do at the start. And one of the reasons for that is because the market is a little bit strange now. And it does make it a little bit difficult in the summertime to get a grasp of the order flow. But first, what I'd like to talk about is the kind of action we're seeing now in the markets. I don't know if any of you have noticed that the markets have been acting a little bit strange. And again, for a lot of you, it just really depends on how long you've been looking at these markets, obviously. So I've been watching the S&P pretty much every day since at least 2005. So that's quite a long time watching the market. And I'm used to particular things happening at particular times of year. And this year is one of them. And what we're expecting to happen is we call it the summer doldrums, the summer slowdown, lots of different names for it. Basically, it's the summer school holidays for the kids, and the market traditionally, yeah, Alex, very strange. The market traditionally slows down for 2-3 months, right? So if we look at summer 2015 here, we can see there's not really a lot of movement. I mean, we're what there? We got 2020 here and 2080 there. So that's kind of a 60-point range for almost 3 months. And if you look at the volume, the line across here is the million mark, or 1,023,000 for some reason. But it's showing you that, we're quite often dipping below a million, dipping below a million, dipping below a million. And then as we get into September, all of a sudden the volatility kicks in. And that was actually the tail end of August. Now, what we expect basically is there's a day in the US, for those who aren't from the US, a holiday called Labor Day. And that's kind of the last spurt of when people are taking a break. And it's generally accepted that after Labor Day, the week after Labor Day, that's when volatility comes back into the market, and that's when people start trading again. And then you get the thing called the Santa Rally, which is kind of usually that people are expecting to lift up into Christmas. So you can see here, very sideways action, 2015. I went back this far because obviously 2016 was a unique year, but we can see it slowed down actually fairly early on, May time, just went sideways, not a lot going on. I mean, we had some big days, but generally speaking, it was very low. I'm not sure what the volatility was on that day, but it looks like I think there was 5 or 6 points. Summer 2016, well, we had some volatility. Now, you got to remember, 2016 was general election, which was made much more interesting in 2016 by the personalities involved. But again, once we got to the middle of July, you can just see it go sideways, and you can see the volatility dropped. ATR, that's a 5-period daily ATR. I'm not an indicator guy, as you know, but that's just a measure of the daily range. This includes the overnight range. So some of these, the actual day range was much lower. We were down to 10 here. So that is a small range. So that's the norm. 2017 was a little bit different. And in fact, it was it almost felt remarkable, 2017. You can see the difference, right? You can see the difference in the period. Look, go back to the two. Sideways, 2017. Lots of really interesting action. And at that point, myself and a lot of other people were saying, wow, does this mean it's the end of the summer doldrums? Is it now that we don't really even need people to be at work for us to have volatility? Maybe it's just HFTs creating the volatility. Well, HFTs would be a bit of a stretch, actually, because they're mostly market making. But, you know, maybe it's some algorithms that are actually moving the market, you know, making decisions. Who knows? Who knows? But so we had a really good summer in 2017. We look at the range, you know, 100 points range. So it's much better. But you can just see it wasn't so flat. And then 2018. Okay, so where we are now, and I'm struggling with it because one of the reasons I'm struggling with it is a little bit because I think I've got certain expectations. So we've had days where it's been terribly slow. We've had days which are quite unusual where we've had a big range overnight and a slow day. So when we look at the overall volatility, you can see we've got some of these big days. We're actually big days overnight where the day session, as soon as the US session opened, it died. That's one of the weird things that we've had. The other weird thing that we've had a lot of days where the day session has started off sideways and then broke out, you know, 1.5, 2 hours in, which is really also quite unusual. And it just might be, you know, might be changing characteristics of the market. But the other thing to consider is, I think basically if I look at this market, there's a bit of me that thinks, well, yeah, it's a summertime, and I keep saying, oh, well, now it's really slowing down, and then it speeds up again, and oh, it's really slowing down, and then it speeds up again. So for me, this is a challenge. I'm not sure if it's more or less challenging for somebody who's not used to this. But anyway, we've got the ATR is much higher so far this summer. I mean, we have dipped down to 20. We've not dipped down to 10s. So we are a much more volatile summer, but it's, you know, overall, but then there are still these periods, start of day, lack of volatility, overnight big volatility, intraday small volatility. You know, everybody and his dog overnight's been talking about Facebook went down 23%, the world's ending. When Facebook goes down, the whole market's going to go down, and all that kind of stuff, you know, trying to really talk the market up. We've opened today, not really done a lot. So is there a reason for this? So, you know, it might be, it's not just an on-off thing, right? So it's not just, okay, the summertime, this summer is going to be volatile or not. It's not just an on-off thing. There's still obviously context. So if we consider for a minute that if we just forget about the summertime, is there anything else that would perhaps dictate the volatility? And this is where we get into prep. Now, I was a little bit surprised. We did a webinar on Friday with Merritt Black from SMB, and there was something he said in there which was, you know, it didn't bother me at all at the time, but somebody mentioned it a few days later, that, you know, Merritt said that, you know, Pete might disagree with, Merritt basically said, well, Peter might disagree with me, but I think you always have to have context. Now, I wouldn't disagree with it. Actually, I mean, I think you can scalp the markets without any context at all. But I wouldn't say that context was bad or that you never need context or anything like that. And one of the customers really took it to heart and said, oh, Pete, you know, what about what Merritt said about you? And it's like, well, that's okay. I mean, it's just an opinion. I'm fine with that. It's not really how I feel. But, you know, I've got no issue with somebody saying that. So let's just think about the context. So I'm not like completely context free. We'll look at the prep in a minute. But if you don't know, I do a pre-market prep every day, right? But I never, ever, ever set an area where I'm going to take a trade before the open. Now, for those of you that are in the Jigsaw chat room, you will know I quite often set a level to trade 2 minutes before the open, because I do that based on intraday volume profile. But basically, from a long-term profiling perspective, or from when I'm doing my daily prep before I start to trade, I'm not doing that to set levels. I'm doing that to get an expectation of what the market's going to do and where it might reverse. I don't need to be the first person to fade a market. I don't need to buy the high, or well, no, I certainly don't need to buy the high. I don't need to sell the high or buy the low, right? I don't care about that. I would much rather the low be in, be clear, and then trade to the upside. So I do my prep because I want to know what levels people are looking at. And I also do it because I want to try and get a handle on what the volatility is like. So if you look at my prep, a lot of the time I'm talking about what I think the volatility is going to do. And maybe if we go this way, I think it's going to be slow. If we go that way, I think it's going to be fast. Now, one of the things, I didn't do the prep today, so let me just have a look. Go and find from a couple of days ago. Let's just bring this over for a second. Right, so this was the day before yesterday. So basically decent volume. Let me make that a bit bigger. So here's where we were yesterday. And I said decent volume yesterday, break above the whole day. We fell back and tested it. And if that doesn't make people come in and buy now, then I'm taking my ball and going home till September. And that's, in other words, I'm saying, you know, we've kind of moved out of this level, away from this area here. We've gone down and tested it, and really we should see some buyers come in, right? Now, I was saying also, obviously, we could just fall back down. But if we do pop up, I expect volatility and participation. So I'm looking at this and looking at this this line about 28.10 here and thinking, you know, this was what we did on Monday. And if we come back down into this area where we just churned and churned and churned for ages, I'm expecting it to churn again. I'm not expecting much volatility. But if we make it to the upside, then I expect volatility upside. And basically saying here, you know, looking for a test and a move up. Less attractive is joining a continuation up. In other words, I'd like to see another test before a move up. But basically, not married to the upside, just ready to take advantage of it if it happens. So there's two expectations there. One is the expectation it's going to go up. But really more than that, it's the expectation that if it goes up, it's going to go up nice and it should pop. And if it doesn't go up, it's probably going to be a bit crap. It's probably if it goes down because it's just going down into the same old area it went in before, right? So that's having an expectation of volatility. Now, what happened? We did indeed get a nice pop, right? And that doesn't make me any sort of magician because basically what I'm doing, I'm not saying the level's going to hold. I'm saying if it does hold, people are going to come in, right? Now, you don't, again, nothing is set in stone. You don't know. But it's just a matter of experience. Now, I can tell you what I use and why, and that's important because I'm going to tell you how I get my expectation of volatility, and it will help you in this summer, and it'll help you next summer. So this is what I use. Let me zoom out of that a bit more. I used to use... Oh, where there? I don't know, where did that go? Oh, did I just kill that? Right, wait there. I was trying to zoom out the chart. It's not a chart, is it? Right, so it's a slide. I'm trying to manipulate it like a chart, like an idiot. Right, so I used to use lots and lots and lots of fancy charting software. I used to use long-term volume profiles. You all know there's lots of people use long-term volume profiles. And I used to draw, you know, pick areas, draw the volume profile around it. But you know what? In the end, I just didn't need to because I could see what I needed to see based on where the market went and turned around. So all I do basically on the charts is just mark up major highs and lows. And I usually try and mark up the first time it hits a low. These are obviously tests. These are tests here. And I just keep those levels on there. Now, obviously, when levels get wiped out, moved over, a lot of times like that, I tend to remove them. But in this case, it was kind of relevant here. So, it's relevant here. So I kind of, I'll leave it on there. But generally speaking, not expecting a lot happen at a level there that's been walked over so many times. But the way I see it, basically, there's lots and lots of ways to kind of manage the market and to view the market, right? And there's lots of ways to set levels. The more esoteric your levels are, the less likely they are to work. So if it's a secret formula and there's only you and the guy who sold you that formula, I don't know, there's just not going to be anyone there to trade it. So I just look for major areas where the market turned around. Now, Mark is saying, I see expectations the same as predicting. So he's saying, can you trade without expectations? Yeah, well, you kind of, all trading is predictive, right? If you buy something, you buy it because you think other people will buy after you. That's a prediction, right? So what I do is I say, well, I saw the market, really hovering around this line, a real inflection point. I see this line as more relevant because we're moving around. And my expectation is, if we move away, people will join in. I don't try and guess if we're going to move away. I don't say, well, this is going to hold. We tested it on this day. We test it now. I expect it to go up. I'm not the one who's buying the line. I'll let other people test it. And if it goes up, I think people join in because they generally do when you move off a level. These boxes here are drawn. The low works a lot better than the high there because we didn't hit the high much. But you see the low here, you know, we come meandered around it here. These boxes are drawn basically because if we get to the extreme of a box, I expect it to go to the other extreme. So that's an expectation, but I don't trade the extreme. So all I'm saying is, well, I know lots of people are looking at these extremes, and if we move away from an extreme, then I think we're going to have more volatility, and I'll join in that. So there's a difference between saying, right, the day's going to open today, I'm going to buy at this price and I'm going to sell at this price. And it's like, that's like trying to predict the high and the low of the day. And I just don't believe in that. I mean, you can believe in it, you can do it, but I think you need to have real strong statistical evidence before you can rely on that. I've just never seen anybody actually doing it. And so that's kind of my experience. But if we look at expectations, this is May here. When we got to this point here, we're moving sideways. The thing you got to remember is if you look back, you've got this big range here that we're in, you know, pretty much since this is the whole of 2018 here. So if you look to the left, you're in the middle of this range. So as you go in right here, there really isn't a lot of things going on except news. There's nothing really technical. There's nothing going in the market that's going to make people say, wow, you know, that's I'm going to buy there, or the market's going to take up from there. So when I look at levels like this, I just look to the left and think, wow, that just, there's nothing there. As we moved up, of course, we've got these highs here. I think this matches about this high here. So as we move up, of course, we're moving up to this area, and then we move down again. Then I can draw the top of my box. Right. As we get to the bottom again, I've got some expectation. So in this area here, we look to the left. There's nothing there. Right. We get up to here. We look to the left. We've got something. Right. We come back down, we look to the left. Yeah, we got something, but it's a bit tenuous, right? We come up here, again, we got something, it's where we moved before, we moved down. You don't have to take the high and the low. You can look at this and use this and not trade the levels, but actually take advantage. So in this case down here, you would be long biased from here all the way up to the top, right? Without ever once predicting a level. Just by saying, look, we've hit the bottom, and it's starting to work its way up, so I'm going to keep a bias long until it's hit the top. Now, when you get up here and it starts moving down, absolutely, you keep a short bias, right? Now, obviously, it didn't play out. You went to the top again in a couple of days, but that's not a big, again, that shouldn't be a big problem. Right, we got to the top, right? So we get to an inflection point. Do we expect high volatility? Well, you only expect high volatility if you get the reaction. So you're looking for it to go somewhere and then to react away from it. And the expectation is if we move away from something so obvious, there's a good chance people are going to jump on it, right? So as we moved here and we started going sideways from here, what are we seeing? Well, we're seeing we're at a level, right? But we're not buying the level. We're not playing a breakout. We're seeing we're at the level and it's not doing anything at the level, right? Nobody's moving first. And so I'm not going to move first. So I'm going to wait for it to move away from the level. I'm going to wait for a test. You know, one of the things I do like to look at, if you look at these, I do like to look at these tests. So if you look at this, this is the market profiles. Now, I use market profiles not because I'm a market profile guy, but because I think it's just a really simple way to look at the markets. But you can see here, this, you know, we moved up to 28.10. This was the overnight session. Overnight session basically went down, tested the prior day's high, and went up. Then we moved down and were almost to the overnight low. And so my expectations when I see things like these daily levels, if they get tested and we move away, they're generally quite good for a run. They're generally quite good for a move. So it's the same thing as looking at these longer terms, you know, because you know people are going to be looking at these levels. And if you do move away, then you can participate. So the thing about this summer, right? We've had good volatility. We've got a looming trade war, which is always good for volatility, any bad news. I think the media is kind of, I think the financial media, there's no reaction to Trump news anymore. So I think that's kind of played out. Anything that's going on with Iran potentially and crude oil will get the market. But so I think we've got a couple of things this summer. We've got some news events. We are in the middle of a range, right? So whatever happens, you know, being in the middle of range, we're going to get that low volatility. But it still does seem that when something happens, like we have, you know, we have a hold of a range here. You know, you get a hold of a range here. You get, you know, you finally break out a range. It does seem we're getting some volatility, right? So now, for me personally, my expectation would be we test this, and then once we tested this, maybe we move back down to here, or maybe we continue moving back down. If we break out of that, then I think it'll be a brave market, but you know, we're not here to judge or value the market as day traders. But that's what I'm looking at. So I just want to kind of look at that and just go back over these summers, right? So this is fairly consistent, 2015. This is fairly consistent, 2016. It just kicked in a bit late, like kind of middle of July, 14th of July, the volatility dropped. 2017, very nice, nice moves. 2018, stop and start. So what I would do for the rest of the summer is just look to the left, and before you open the market, look to the left and say, look, is there a clear run? Is there a clear run? You know, moves up are probably going to be followed, right? Because we've cleared this area we've been in for months. So we've kind of got a clear run at it. If we fall back down into here, it's probably going to be a little bit choppy until we can break properly, you know, from the top of this and go down to here. If we get to the bottom of here and we start to move up, we should have a fairly decent move up. It's not going to be a one-way move, but, you know, people are going to have an idea. People are going to be able to say, yeah, it's going from here to here. And that's, to me, that's about as good as it gets in terms of analysis. Now, if we can break out or break down, everybody's talking up a market crash at the moment. One of the interesting things for the newer guy, if you're newer to trading and you're listening to all that financial news, they sound really, really smart until you realize that they can only predict yesterday's move, right? They always give you a reason for yesterday's move. There's never any pundit on the news telling you what's happening tomorrow. I mean, if any of you remember Peter Schiff, I don't know how long Peter Schiff has been like, I think they've stopped putting him on the news now, but he's been predicting the fall of the USA for about 15 years. Gold's gonna, you know, put your money in gold. The US dollar's gonna crash. And he's been on that. I might even be since the late 90s, and I think they'll stop putting him on now. I think they're putting him on. I think probably Alex Jones has him on now. But you notice the financial press, they're always really good at predicting a move, and what they'll do is when they see a move up, they'll kind of talk the move up. They'll say not only will they predict why the move up happened, they'll also predict why the move up's going to continue. And then when it doesn't, there's no recourse at all. There's absolutely when that move doesn't continue, there's absolutely no recourse. They never come back and say, look, you know, we're sorry, but it didn't go up and we thought it would. And so what will happen after any big move down, they will be talking the market down a storm. They were talking the market down a storm here. They were talking the market down a storm here. Right, they talk the market down because, it's moving down, and they all get, it's going to go down, it's going to go to zero, it's going to go to zero, and then it moves back up, and then they get just another series of pundits who are bullish on, right? So you've got to tune out the news, right? And the best thing to do is do what I do and just do a prep every day, and in the prep, just say, you know, if it might react here, and this is where I think volatility will come in, and then every day at the end of the day, or the beginning of the next day, which is what I do, just have a look how you did. And what you'll find, if you do that, you'll actually get better and better and better at predicting the volatility. You'll get better and better and better at predicting where people are going to come in. You'll be able to look at the market on a Tuesday morning or after the Monday session and be able to predict that week's going to go sideways. Right? There's certain things that happen, and you'll see it in my prep on a Monday. You know, I'll be doing my prep for Tuesday morning. And what will happen is the Sunday overnight session will be in the Friday's range. The Monday session will be in the Friday's range. And then we'll start the overnight Tuesday session in Friday's range or about that. And at the moment you see that, it's like, just makes you want to pack up for the week. Because it generally means the market's just going to go sideways, right? So anyway, that's kind of the volatility. Anybody got any questions on that? Is anything unclear? Everybody's clear on that. Okay. Right, what I want to do then is just switch over to the actual markets, right? Do I feel that big moves are necessary in order to make money? No, I don't think big moves are necessary, Alex. I think here's the problem, right? It's not really about whether a move is big or small that's an issue. One of the reasons you want to try and predict the volatility is because you need to kind of adjust your strategy based on the state of the market, right? So if you come into a day and you presume that day is going to be a rip-roaring 100-point day and it's going to go up 100 points, then it stays in a 5-tick range and you play your 100-point game, you're going to get really stiffed, right? So if you're looking at just today, let's just look at right now. Yeah. Okay. So what we can see right now is the kind of three things you look at intraday to tell where you are intraday. So you're going to have that prediction of volatility or where volatility is likely to come into the market. That's your first thing, right? Then the day starts. What have we had this year? We've had day starts where overnight's been absolutely amazing, and then we've come into the day and had 9 points on the S&P, right? We've had days where, you've had a massive day one day and the next day it's 10 points, right? It's really slow. You've had days where the market opens and does nothing at all, and you just get sitting there 1 hour, 1.5, 2 hours, and then it shoots off, right? So it's one thing to have that prediction of volatility before the market starts. The next thing is to try and figure out what the volatility is doing right now, right? So you don't need big moves, right? What you do need is to understand the market state at the moment to make money, right? So if you look at what's going on here, you've got the Dow moving sideways. Now, it might even pick up a little bit there. The Dow looks like it's a little bit behind. You've got the NASDAQ, which has moved down, and we've got a little bit of absorption on the NASDAQ, not much. And the NASDAQ's lifting up. So the first thing, if you're watching this particular three sets of markets, if you've got the Dow and the NASDAQ doing different things, you've almost always got the ES going sideways, right? Now, that changes. It's going to change. It doesn't change minute to minute, but it'll do something for 20 or 30 minutes, and then it can do something else. So, you might see it opens really slow. Quite common this year. You've got the Dow, Dow will be flat, NASDAQ's going up or down, S&P's slow. And then over on crude will fall out of bed. Crude will start to dive. And then all of a sudden, they all start going in the same direction, right? So what happens is the market will be doing one thing and something will just trigger it to do something else. But right now, you've got the Dow now sideways, NASDAQ going up, S&P is sideways. So basically, if those markets are not moving together, it means you've just got general low participation. So normally on a nice active market, you've got arbitrage across those three markets, keeping them in line. And obviously at the moment, there's just not a lot of that going on. So it's a low participation, low energy market. So a really simple, such a simple thing to have the Dow and the NASDAQ up when you trade in the S&P, and just say, okay, if they all start to scream up now, because this looks like a reversal, you could say, well, the S&P is going down, when it's in the middle of a range on the profile, look at it in a second. But you could say, the NASDAQ's bouncing up, the Dow's starting to bounce up, I'm going to go long on the S&P, right? But you really want to see, because they're more volatile, you really want to see the Dow and the NASDAQ start to really start marching up to give you a chance of good follow through. And that's when you're going to get the big moves, right? At the moment, what have we got, right? If we just look at the, let's just make that a bit bigger. Right, the volume profile. This is the other thing to look out for on the S&P, right? So we've got basically a 10.5 point range, and we've got this very D-shaped profile. Now, D-shape, just this rounded Gaussian shape. So what that means, very simply, is that the market's just been going up and down through that price and trading more in the middle. Now, one of the things that a lot of people say, we've got this price called the point of control, 29,000. That's where we've got the most trade. To me, that's probably the worst place to enter the market. And the reason I'll say that is because a lot of people say the point of control, the place that we did the most trading, is where the most people agree on price, Okay, so if people agree on price, then actually it's where people mostly disagreed on it, right? Because if people agreed on price, you wouldn't have half of them buying and half of them selling at that price, right? I mean, if we all agreed that 28.42 was really cheap, everybody would buy it, right? But actually, 29,893 people thought it was expensive and the same amount thought it was cheap, right? And that's why we traded the most there. So you tend to get a lot of trade around these areas. But once you've got this thing, so right now, looking at this market, 38, 44, 44.25, they're good places to fade the market, right? Anything in the middle is tough trade, right? It is really tough trade because it's just going to churn around in the middle. So one of the things to look for on the S&P while we're looking in the holiday period, obviously we've looked at our long-term levels, but intraday, look at this, Dow sideways. Nasdaq was moving up and that's kind of moving sideways. S&P, so there should be no expectation of any sort of momentum trade on this market. So if you're only looking at one market, I mean, I know a lot of professional traders. I don't really know. I don't think I've met one that just looks at one market. I mean, yeah, there are some crude markets traders that trade momentum. That's kind of a different deal than trading the S&P. The S&P really is about the state of the market. So I don't really know a professional trader that trades the S&P on its own. Most of the trades I know, they've got like 20, 30 markets up. They're not looking at them all at the same time, but when they're looking at one set, they're looking at them together. So just by adding the Dow and the Nasdaq, you already kind of speed up your ability to react to the market. And then the volume profile as well. The volume profile is also very important. Now, if the market was trending, you get a very different profile. What you get is you'll get, like, let's say the market had moved down. You'll get a move down like that, very thin area on the profile, and then you'll get an area, 4 or 5 prices where you've got a thick area, and it'll bounce around that for 5-10 minutes, and then that thick area will break, and you'll get another thin area, and then you'll get it'll stop and bounce around an area for 4 or 5 ticks, and then move out and keep doing the same thing. So it'll move, build volume, move, build volume, move, build volume. That's what you want to see in a trend. You also want to see the Dow and the Nasdaq moving together. On a day like this, what do you need to see to take a momentum trade? Well, you can take a long off 8.38. You can take a short off 44.25. They're the fade trades. But what you need to do is very patiently wait. At some point, we'll break out of this area. Might not be today, but at some point, we'll break out of this area. Now, most of the traders that are trading today are intraday traders, and they can all unwind their positions within this area here without a problem. But if there is something that kind of gives the market a nudge one way, then we're going to see a lot of people. So if it nudges it downside, we'll see a lot of longs unwind, and that just might be enough to get people to trade directionally, right? So what we've got now is this is a fact that this is where all the volume's traded, and there's nothing to do other than fade the extremes of that volume until it breaks. And then when it breaks, you really want to see a rapid move out and some really good volume on the rapid move out, some stops. And then ideally, if it came back, if it broke out and then came back to 37.75 or 38, that would be a perfect short, right? Because you've got longs and shorts in this area here where you've got a lot of volume. But if you have a stop run to the downside, the longs have got stopped out, or a lot of the longs have got stopped out. So when you come back to 38 here, you're coming back to where a lot of the smart longs got long. You're going to find that after a stop run, they're not going to want to go long there again, right? Because if you've ever lost money in a place at a price doing a long and it goes back there, your tendency isn't to long it again, right? So basically, we expect the volume profile to hold. When it breaks, when it finally breaks, and we see evidence for stop run, that high volume, really fast move, when it comes back to test, you really don't expect it to come back into this area, right? Now, for those of you that are new to this, let me just find a different workspace. Okay. So one of the things, if you're new to this, there's a drill, right? There's a drill we've told you to do that says, you need to watch the market and you need to watch for certain things. You need to watch for pace of the market. You need to watch for areas that are sticky where the market gets stuck. You need to watch for how it moves up and down. There's a problem watching that on the S&P right now, and the fact is the S&P is just not moving much, right? So using order flow on the S&P right now, it's kind of pointless. Now, what we can see, if we look at all the volume and all the different values here, 812 is the biggest we've seen anywhere. So it's just traded more at 39.75 than it's traded anywhere else. And this is one thing you'll see on lots and lots of markets. Now, if I just clear that up above us. Okay, sorry, wrong button. Okay, so we know those numbers were down. So we have now, if you're new to this, just because that's happened, now you don't just say, I saw a lot of volume at one price, therefore I'm always going to go long above that, right? But we're in a slow, choppy market, right? So there's a couple of things about a slow, choppy market. First of all, it's not going to run against you very quickly, right? So this market, if when we saw the 812 there, we could go long the price above 28.40 and said to ourselves, well, if it dips below 39.75, below this where it's 812, I can actually get out and I can effectively have risked 2 or 3 ticks on a trade, right? Now you can do that today quite comfortably because the market isn't running around a lot, right? It's not zooming one way and the other, right? So if you'd have gone long 28.40, today, because it's a slow day, that you've seen more volume trade into the bids, so more sell market orders trade into the bids than you saw anywhere else, right? We got 812 versus 455 at that price, and price couldn't get through that area. It means that temporarily at 39.75, the bidders stayed firm. Right, and now you can see the market lifting. It doesn't mean the market's going to go up 100 points, right? It just means that I've got a slow market. I saw an exceptional amount of volume trade at a price. It's not going to run against me very quickly. So if I trade just the other side of that volume, so I could have traded 28.40, plenty of time, stop at 39.50. I'm in a slow market. I've got a 2-tick stop. I've got a good reason to get into a trade, and that's what tape reading's all about. Now, we're really lucky that happened while I was talking, right? And you can go back and look at the video. It is recorded. But that's effectively the kind of thing we want you to see in the order flow. But what just happened there, we were really lucky because it just happened while I happened to be talking about that kind of thing. But you can spend a long time looking at the S&P right now and not really seeing anything. Right now, let me just save my workspaces because I'm going to move something across. Now, even if you're normally an S&P trader, right, you got to understand that this is the summertime, so the markets are slow. So if you're learning order flow for the first time, you're better off starting on a market that's a little bit faster. I didn't download the bund FG. Okay, FGB. Yeah, I did know that. Okay. You're better off starting on a market that's got a little bit more volatility because with the slowdown, you're not going to see that much, right? You're not going to see that much volatility. So looking at the bund here, it's not actually that much more volatile. The range isn't that much bigger. The market depth isn't that much lower. So the bund's probably not a good one to look at. If we look at crude, then you can probably say, yes, crude's a better bet. We've got a decent range, 68.92, exactly $1. Is that right? Yeah, exactly $1 range. That's good. And so we've got a decent range. We've got lower liquidity, and we can watch these numbers playing out. Now, the other thing is when you're starting this for the first time, so you need to pick a market that's got some volatility. Right now, you could start off on the ZB if you want. So let's look at the treasuries for those of you that know. So you could start off on this, but wait for the daily range to pop up. But look at this. Look at the depth here, the numbers here, and look at the daily range. Right, that's a really tough market to start watching because when you're first watching it for the first time, you're going to spend an hour to 90 minutes, right? And you're going to sweat right? I remember I went on a flight simulator, and it's absolutely, if you ever get a chance to go on a flight simulator, like I think mine was an Airbus A380 flight simulator, and I went on for an hour, and to be honest, I was sweating. I mean, it was just ridiculous. I was nervous. I was sweating. Not really so much because I thought I was gonna crash the plane, obviously, but because it was took such a lot of focus and so many things to do, right? So it's the same with this, right? You're going to focus on this, and you're going to be trying to watch it. You're going to really be putting all that effort into focus on it. And look, since I've been talking, we've traded one contract, right? You can't start looking at order flow, looking at the ZB. You're better off, if you're going to trade the ZB, you'll be better off recording it for 2 hours and playing it back on fast forward, right? To kind of see the things you want to see. So if you're doing this for the first time, I suggest, even if you're going to trade the S&P, trade a more, just choose a more volatile market to trade. Now we'll just look at a couple of others. Russell, let's just look at the Russell. Okay, right, so let's just, and I'll just clear these. Okay, so we've got Russell, Dow, NASDAQ, S&P. You can see the Russell has got a really nice healthy range. So let's just watch it for a little bit. The Dow is good, but usually, I mean, today's probably okay for the Dow, but the NASDAQ. Usually the NASDAQ's a bit too fast for most people, and it's a little bit too fast to watch for the first time. But you can see the NASDAQ has always got moves in it, but you're really not going to see that many times when you get that kind of absorption event where you see a lot of the market get stuck at one price and kind of churn there and move up. You'll see it a little bit on the Dow. You'll see it a little bit more on the Russell, on the S&P. But you could actually, I mean, it'd be a bit much to try and put all three together. I shouldn't tell you that. But basically, Russell doesn't look too bad. S&P doesn't look too bad. We're going into lunchtime now, so you wouldn't do it now. So usually from like 8:30 a.m. Eastern to about 10:30 a.m. Eastern would be your kind of prime times for watching these markets and just watching the flow. Replay isn't bad, but replay it's generally a bit it's a bit chunky, so you're better off picking a market you know. But basically, we want to watch a few things. We're trying to watch the way it moves up and down. Now, the best way to think about the way it moves up and down is a bit like if you're at the beach and you're trying to, you're running in when the waves go out, and then you're running back out trying to keep your feet dry when the waves come back in. So the waves go out, come back in, go out, come back in. Now, somebody I spoke to earlier said, I don't think I've got the intellectual capacity to read order flow. And I think sometimes the reason people think that is because they believe that it's an intellectual event. They see numbers on it, they say, well, I can't keep up with all the numbers. Well, actually, the only thing you need to be watching to see the waves go in and out, the only thing you need to actually watch is this yellow line here, right? So just watch it move up and down, up and down. I think it's better to watch these middle columns here. But you're not looking at the numbers. You're just saying, well, you've got a center line up here. Okay, so you've got something to kind of anchor off. And then you're just watching it move down and then move back up and move down and back up. And just trying to get into like the rhythm of the market. It's going 4 ticks back, 8 ticks up. 4 ticks back, 8 ticks up. Just to get into the rhythm, right? The other thing you're looking at, which is a bit more advanced, is the numbers themselves. To just look at the numbers over time. And there's two main things to look at when you're a beginner. Is one like we saw earlier on the S&P, where we saw it hit a price. We saw an exceptional amount. So basically what that means is you're just looking for a big number, right? So you've gone from just watching it move up and down to actually observing the numbers and just waiting for a big one, right? So that's the other thing you want to watch. Then a little bit more difficult is looking for areas where you don't want to trade, where you run out of numbers, where the numbers become really small and you just don't want to trade anymore. So that's kind of the next thing you look at. After that is stickiness, right? And stickiness is a really hard one to describe, but sometimes the best way to think of stickiness is the time you'll see it the most. And this is a strange thing about the markets. It's a lot easier to tell if your trade's going to fail than if the market's going to go up or down, right? And by that I mean, if you're not in the market, it's really difficult to tell what it's going to do. But when you've got money on the line, it's really easy to know if you're going to lose money. Now, that doesn't mean you're going to get out of the trade because you know you're going to lose money. But just think of it. How many times you got into a trade, let's say you trade the S&P, and the market's gone up 3 or 4 ticks. And it's, for me, first target's usually around 4 ticks. And it goes to 4 ticks, and it trades 50, 60, 90, 100, and I don't get a fill, right? And then it kind of ticks down. And then it ticks back up to my price, and 5, 10, 50, and I don't get a fill, and it ticks back down. And every time it moves away, you know, you've got your entry price there, and it'll tick up 3 or 4 ticks, and it'll just get up there, and it's just almost like you're trying to get to the top of the mountain, and you're just sliding back down again. And it just seems to take so much effort for the market to make each one of those little ticks up. But then it gets 4 ticks your way and just slides down 3, right? And that's kind of like called stickiness. That's what I call stickiness. And it just can't make it. It just can't stick at prices, right? Now, have any of you ever noticed that when you're in a trade, that it just seems to be taking so much energy to move your way away from your entry price, but it keeps ticking down really easy? Have any of you ever seen that or noticed that? Could be just be me. All the time, Alex, all the time. All the time. You know, that reminds me. I was in a casino in England once, and I was playing blackjack, and the cards were terrible. It was almost like it was rigged. And I said to the guy, now I was just there for a laugh. I was on holiday, and I said to the guy next to me, I said, these cards are terrible. And he says, yeah, they're like that every day. And it just made me laugh. It's just like you guys saying all the time. It's not because you curse with bad luck, but okay. So the guys that said you see that a lot. What percentage of the time do you exit the trade when you see that? Jason, Omar, Victor, and Mark. 100% for Alex. Oh, he's a good boy. Go on, Victor. How often do you get out when you see that? A lot of the time. Good, Mark. 20%, Victor. Alex, you need to give Victor some lessons, right? So basically, it's one of the key things you see. One of the key things you'll see for trade management is that stickiness. It's a lot harder to see it when you don't have a trade on for some reason. There's something about having a trade on that focuses you. But anyway, it's that stickiness. It's how the market is. It's so easy for the market to go one way, but so difficult for it to go another. And what happens is it keeps pushing one way, falling back, pushing one way, falling back, pushing one way, falling back, and then you know, suddenly 4 or 5 tries, boom, it's going to slide the other way. And you know, we sit here like Bambi with the, you know, deer in the headlights, sitting there watching this happen. We've got to get out. Now, the reason we don't get out is because sometimes we get out and it goes up, but that doesn't matter because these markets are binary. The markets can literally only go up and down, right? So for you to kick yourself because your market goes your way after that, what you have to remember, right, is if you knew that the market was going to go down, right, if you knew without doubt that the market was going to go down, right, then you would not exit your trade, you would reverse it. So if you haven't reversed your trade and you just exit, you have no right to kick yourself if it then goes your way, right? Because you were not certain it was going to go down because you'd have reversed it, but you also were unsure it was going to go up. So you exited, which is a good call. So happened to Mark on the NQ, stopped me out on a stop run by 6 ticks. That's not bad, 6 ticks though, to be honest, on the NQ. Yeah, it's not your trade, not your expectation. Now somebody's asking, NQ and YM, would you move down? Absolutely. Would I fade the S&P? Absolutely, yeah. But let's just watch what we're looking for. So if we want to fade the S&P, what do we need to do? We've got 2 things we can do, right? We can just put in an order at 38.50 and just let the market move up, right? That's one way to play it. But we've still got, even if we fade it now, even if we got in at 39.50, we've still got a decent run. So what do we need to do? Right now, Nasdaq's running down, Dow's running down, it's kind of stuck a little bit, Russell's running down, so we've recentered it, everything is below the center line, right? Now there's a possibility the S&P will be the first to move up, right? But at the moment, okay, we've just traded 61 here, on the anode, we just washed it out, right? So they're still pushing down. So we want to really see some activity to the upside before we do that fade trade. I mean, this is great now because this has moved down even more. Let's just recenter those. This has moved down even more. We've got potentially a much better fade trade on now, right? But we need to see something to the upside. We need to see some momentum to the upside. So all we've got now, I mean, I've got an NQ chart here. We can see it's just tearing down, right? So at the moment, I wouldn't take the trade. So I'd need to wait for some confirmation. So basically, what you want to see is everything start to tear up. Now, if everything starts to tear up, you've still got plenty of room on the S&P. So you see everything's moving up now. You could use that as your long signal, right? You could say, right, I'm quite happy to go long. I wouldn't mind waiting a few ticks up. Because if you go long here, again, the market's not going to break down and just whip against us. So we can say, right, I've got to, say, look at 38.25 here. I've got everything going up. So I'm not saying you should do this, but sorry, let's just put a sim trade on there. So if you went long at that price, sorry, quantity, I've got a quantity wrong on there. All you can do if you're long is just say, okay, I'm going to reset this. And I've gone long off the bottom of the range. So the bottom of the range, really probably 37 you don't want it to go to. What do we do? If all of this stuff starts, tearing down again, we can just exit the trade, right? So right now, if everything stays above the center line, we can stay in the trade. And if it just moves sideways, we can exit the trade. If everything starts to tear down, right, it's all moving down again. So that's our first shot up, and we haven't done anything. Okay, a good run down on Nasdaq here, we'd probably say we've had enough. And it's never going to be the fastest trade. Now, you could decide to scratch this and say, you know what, I'm not sure about that, but I'm still interested in the trade. Look now, Russell down, Dow down, Nasdaq down. Okay, it's time to say it's probably not a good idea to stay in this trade anymore, right? But what you could do still, you could say, well, it's probably not going to pop. Oh, it is popping now. Okay, so you're still not going to get the market just tearing against you, right? So you still got a little bit of time. Still got a little bit of time in the trade. Okay, so now you're out. But you saw basically that everything was pushing down, right? So that's not what you want to see when you get in a trade. Now, if we can just see if it does hold. We've not seen a stop run yet. So let's just see if we do start to push up on everything. Now, of course, that was a kind of a forced trade there, because I said already, you want to really see some upside momentum. Okay, so now we're seeing some upside momentum. Now, if we were just going to play pure momentum trades, right, and we took that, let's not set the quantity, we'd also want to get out as soon as this momentum stopped across these markets, right? So if we don't see follow through on all of these markets, we just scratch this trade, right? So now this time we've got some follow through. Now, if it all comes back down, we can just scratch out. We can even say, right, I'm going to take a tick profit, right? So everything's come down again. We've still got some breathing room in the trade, right? We had a bit more momentum. We just need another push up. If we don't get the push up, you can scratch a trade, right? Okay, just waiting for follow through. Okay, so you can kind of get in and out. I mean, if you took the trade here and said, right, I'm just gonna get a tick and just get some commissions and pay some commissions for the next trade, right? You could do that, but at some point you actually want to see these other markets pop and support your trade, and really they're just kind of wavering around at the moment. But you've kind of de-risked things by all of these markets are up and we're up as we went into the trade, and they're all staying up, and it kind of de-risks the trade a little bit. But you just can't be the deer in the headlights, when all this comes down. So I think if all three of these now went below the center line, you'd get out, right? And you could actually probably say you've got good cause to get out now, because we stuck at this price, these 23 contracts here, quite a while, and we've not really got above it. So you could say, right, if we can't get, on this next push, if we can't get above this 23, then we could scratch a trade. Now, it could still go up, but like we're needing some momentum. And if you look where we are, we're still, this is where the step in the profile is 14,905. So it's okay. We've gone down below. We'll just wait a little bit more. Now what we can do, we could just get in that again. If we can see all the markets leaning up, we could just get in that again. So if we see them all starting to really push up, then we can in it again. And as long as they're all pushing up, you've got a cause to stay in the long trade, right? But the moment they all fall down, you really got to start to unwind that trade. How do you know it won't keep running to the downside? Right, a couple of questions. Oh, okay. Would you fade it? How do you know it won't keep running to the downside? Well, at this point in time, you know that the ES isn't going to tank if the other three markets aren't tanking. ES isn't going to just tank 10 ticks on its own, right? So that's not going to happen. If they are all trading on the buy side and moving up, also the ES isn't going to tank, right? So it's just like you see, look, they're all kind of trading on the sell side. So it's basically it's like the leaning tower of pizza, right? It's leaning. While it's leaning that way, it's not going to fall the other way, and it's just the market's just leaning one way. And because you've got all three markets leaning the same way, it's kind of safe to stay in a long trade. You've got more time to manage a long trade, and you can test that yourself. Just watching when the markets all run the same way. Just get long on the S&P and get out when they all start to move down. You know, I mean, what we're seeing now is just chop, right? So that mark, you know, that was because Alex said, well, who asked the question? Alex said, with NQ and YM moving down, would you still fade the ES at that level? That was the question he asked. So he was talking about fading. We was talking about fading the S&P here, you know, at the bottom of this range, so about 38. But you know, because we've got, like I said, because you got a bit of room up there, you know, you could trade long at 39, and as long as everything was trading up, just stay with that. So that's why we kind of talked about going long there. Do you like trailing stop? I tend to put a trailing stop on, but I tend to move it out of the way a lot, and I don't know. I quite like it. I mean, if I take my eye off the screen, it's fine. I like trailing stops more when I'm in profit. You know, when the markets actually run a bit, I like a trailing stop then, because it just I don't have to make the same decision. I can just let it run a bit more. So I like to have scale out targets above and a trailing stop below. So I've almost gone on for an hour now. So for those of you that are new, do you understand a little bit more about what to watch on these center columns, and that it's really, really important to pick a market that's moving, so that you're not just sitting there bored. So for the new guys, are you okay on what to watch, or do we need to do another session on that? Okay, Craig. Craig, you know, you can always Skype me if you run into trouble. Okay, and then any other questions? We had a couple of questions, but not many. Any other questions? Okay, I've probably got it fairly lightly. I think I was... yeah, I mean, Mark, yeah, it's... You know, we can do a session, Mark. There's a couple of people that actually want to do a session. We could do a separate session, but how do we use the lower left indicator? This is the flip chart. I mean, this is just the market flipping left to right. We'll do that in another session because we're already at the hour. I will do a session for complete newbies, Mandeep, next week or so. And what we'll do, Mandeep, we'll use that session to create a new beginners video for the website. So I'll do some prep for that. Guys, well, I appreciate you coming. If we're out of questions, then I'm going to go and spend some time with my daughter. So I'd like to thank you. Yeah, don't ignore the numbers, Mark. It's not the numbers that are important. It's just the flow. So thanks again, guys. I hope the stuff on the summertime markets was helpful. So just keep your eyes to the left. And if you're in the middle of where we've done nothing to the left, then just don't expect a lot from the market. So thank you, guys. And I'll post this recording in the next day or two. And good luck with your trading.